going to bust. They're going to flood. You're going to have much more issues because they're not as insulated as they would be if they're inside the unit. So being cautious in how you design and how you put things in the areas in which you're trying to develop is something to always keep in mind. And what Mike is mentioning with credit delivery, understanding that these are built-in safeguards, but sometimes you can't change the weather. If you get built and you're building in a town that doesn't have all of the right resources and you got to ship all that in, people get sick, things happen. There are some things you can't control, but working on the communication and things you can control are always, in my opinion, helpful for moving forward to minimize your risk cost.
Absolutely, Patricia. That's a good point. And to add to that, in regards to that question, go towards your strengths. We're all chasing points when you're doing your application, and you go down the list and like, oh, I think I can do that, right? And you start checking these boxes, and you've never done them before. Some are more complicated than others, and it's not just might be build a swimming pool. It might be doing things that you haven't done before, like the social services and so forth. So, again, stay within that box, or learn what you have to do. Learn that execution before you actually check that box, and then go, now what do I do? Anybody else? Any thoughts on that? All right. Okay. All right. So. I just wanted to touch on AHIG for a minute. Just again, if you haven't been exposed to this, again, it's the Affordable Housing Investor Council. Your syndicators and investors follow some type of a risk rating. They're going to grade your property. They're going to every quarter with your quarter financials. They're going to grade it, and they're going to say, "How you doing?" Just like in school, it's an A, B, C, or D, or F. In this situation, what AHIG does, and as you can see here. A is excellent, B is average, C is weak. So some of us, our kids, at least my kids, like, hey, I got a C, Dad, that's okay, right? It's like, no, C's not good, and especially here, C is not good. So if you get a C on your report card in AHIG, you're actually in trouble. You're having some trouble. And if you read down here, it says an asset that is rated a C is basically going to be put on the watch list. And if you're not familiar with what a watch list is your syndicator and your investor saying, we're going to watch you much more closely. We're going to ask for more reporting. We're going to come and do more inspections, more scrutiny. And again, it's like, hey, that's their job. Well, guess what? They're going to call you up because they want to visit the property. They're going to take your time, right? They're going to come out. They're going to ask you for more reporting. You're going to have to generate all that. So it's going to be a cost plus for you guys that you're already doing, but now you got to do more. So again, you don't want to see. You want to stay in that A's and B's. Let me just take here real quickly what these are. That's pretty small. So I'll just read. I'm not going to read all this. So this will be quick. Yeah. So the over here on the left is our categories over here. So this is construction lease up, finance, construction loan, perm loan, and program compliance. And then you can read across what each one of those are, but it gets worse from one to the other. So, A for under your construction lease up, the construction lease up, you're on schedule. B, you're on schedule, but you're within 30 days. Then you get up to 90 days, and then D, you're in trouble. You got mechanical liens coming on, and then F, you're just failing. So each one of them will carry that same type of a review. You want to be in that A and B category. And of course, in the compliance section here, you definitely want to make sure you stay in compliant and follow those requirements. And then this is page 2. Just a few more categories. The general contractor, again, they're measuring the general contractor. How are they doing it? Are they on schedule? And then the one that I think a lot of catches this, a lot of people don't realize this, but this one here says the general partner, sponsor, developer, or management. They are asking for those companies' financial statements, and they're measuring those companies. How are they doing? Are they still solvent, or do they still have enough money when they get into trouble that they can cover? They're going to make sure that they're in bed, so to speak, with partners that can carry their weight and get through this deal. So very, very important to pay attention to this. Ask your syndicator, ask your investor, hey, Do you guys have a risk rating? How do you use it? What, can I get a copy of it? Because it'll be a little different from what you're seeing up here. And it may be 1, 2, 3, 4, 5 versus A, B, C, D, F, or some other calculation. But again, ask for that. They'll think, hey, these guys are smart, number one. And number two, it is absolutely, you'll have the cheat sheet on what you're swinging at. What are they going to measure? So, Patricia, I think that ends my first section here.
Fabulous.
What is next?
All right, so we're gonna dive into eligibility. So this is, I think, the fun part that most of us love because we get to calculate things and get people into housing.
This is absolutely our most hands-on part. Eligibility is really important. So first we'll talk about some of the common programs we all pretty much know: housing tax credit, home housing trust fund, TCAP, and project-based rental assistance. It's important to maintain a good compliance program because you want to not only protect your funding, but you also want to make sure that you're serving the residents that are most in need, the low-income households, the low-income families and individuals in Texas. And for all of us here, we all know how important it is to make sure that our partners meet our funding requirements and regulatory requirements and all the commitments. Forgot that was my part. So some of the key factors in compliance that you want to start off your compliance management program with is identifying important documents. So one of the first one is the regulatory agreement. Like Kara said, in addition to the application, we want to look at the regulatory agreement, or the land use restriction, LURA, as we call it, and make sure that we know all of our property specific requirements, everything that the property is specifically committed to, your minimum set aside, your additional restrictions and things like that. In addition to that, you want to look at your 8609s. That's going to tell us what projects we have, whether we can transfer units, what type of recertification we need to do. Some very specific information on that 8609 that's important to managing your property. Policies and procedures are extremely important. Internally, you want to create a policy and procedure. That way you can, your company, your property maintains consistency all throughout the process. That way they know exactly what's required. When a sticky situation comes up, you have it in writing. It's clearly identified what to do next. Your resident selection criteria. In Texas, we have written policies and procedures, so that a lot of time goes along with your resident selection criteria. It's important that especially for your on-site team, that you guys memorize this, have a good understanding of exactly what the property's requirements are for your applicants, people coming in that apply for a household, that apply for an apartment. Your income and rent limits. You want to make sure that you're using the applicable rent limits. HUD publishes your income limits every year for every county and area in Texas, and different programs have different data sets that they use. So make sure that you're using the one that applies specifically to your project, to your property, and that you're updating annually, keeping up with the most current income and rent limits. And then utility allowances. Kara's favorite. We have the state of Texas. There's several different methods that we can use. This has to be updated annually. Of course, there's the Public Housing Authority, there's the HUD income limits, and then there's those additional ones, actual use, energy consumption model, a local estimate, and I call it the HUD model, but it's the HUD utility schedule model. Those are all alternative methods that you can use. Calculate your utility allowances. It's annually. It's based on what the utilities that the residents actually pay. And it has to be, for those alternative methods, it has to be updated annually and sent to TDHCA before October 1st. So make sure that you have an approved utility allowance schedule and it's updated every year. And then, of course, when we're talking about eligibility, we can't forget the resident files. The resident files are your big picture document that, your big picture file that documents eligibility, making sure that, again, like that you are working with eligible households, the people that need this affordable housing the most.
You bet. I don't know about you, but I don't ever worry about that till I lease up the property, right? We don't need any of those things.
Oh, well, Not quite.
Yeah. Those, all
Not
those
quite.
items should really be discussed in those handoff meetings because the majority of them are made even prior to the application being submitted. So
Right.
the information is available, just needs to be discussed.
Especially when leasing up your property. When you're leasing up your property, if you don't have that basic information, or at least the knowledge of what's intended to be put on the LURA or on the 8609, then it's going to be hard to run a success, to make sure that you're in compliance with all of the needs. So
I have a quick comment on the 8609s. It definitely is important to get a copy of those. The 8609, it is I didn't think about putting a picture of it in this slide, sorry, but it's an IRS form. The important note is the first half of the 8609 is filled out by the state. So that top half of the form is going to give you your credit amount and basically your maximum qualified basis. The second half of the form is going to be a lot of the elections. That's going to be filled out by the building owner, probably with the CPA and maybe a tax credit consultant if they worked with them. So when you have the 8609, you definitely want one where the bottom half is filled out and signed. I think a lot of times, we'll ask for 8609s, they'll send us what they have on file and it may just be the top half. If you just have the top half, it's not going to tell you the set aside. It's not going to show you the year they started credits. So you really need that like completed and signed full 8609 to have all the information that I think compliance needs.
And to piggyback off that, you need the attachment.
You're right.
If
Yes,
8B
you're right.
says you're a multiple building project, you need the
Definitely the
attachment
attachment.
and not just the form.
Yeah, that's a good point. There is, I forgot to mention that it's 8B is the line number on the bottom half, and that designates if you are a multi-building project or not, which has huge implications for, eligibility and if you can move tenants between units and all that. And that's also something else that it's like communication is key there. It's difficult for us sometimes to know as just the CPA doing the cost cert, did you intend for this to be a multi-building project or not? But if you check that box, you do have to submit an attachment to say like list all the bin numbers that are in that multiple building. So that's important for you guys too.
So one property.
Yes. The bottom half it's going to be the building owner that fills it out and signs it. The bottom half, a lot of times the building owner will lean on like the CPA or the tax credit consultant, people with knowledge of like the details of the cost cert. So the building owner is responsible for signing it, but usually like a CPA or consultant will help you fill it out.
That's what I was about to say. I was like,
Mhm,
they may
yeah.
sign it.
Yes, they may sign it.
Typically that handwriting will be a little different on some.
Yes. Yeah, definitely. It's going to be all the information that's really in the cost certification file. So a lot of times the CPA is the best person to help fill that out.
And with that attachment, when we talk about the building, the bin numbers listed out, within one property, you can have an apartment complex, but within that property, you can have different projects. So many buildings are part of one project and other buildings are part of another project. You can have 2 or 3 projects within one property, and that's going to affect a lot. Like Ellen said, whether people can transfer, how people do their annual recertification. So it's important to have not only filled out, but to understand what it means. All those boxes that you're checking, it's going to tell you when your credit period starts. If it starts on the year of place in service or the following year, it'll tell you the place in service date. And there's just so many critical items on that should be explained to management and on-site team as well. Yes. Can you use the Housing Authority Utility Allowance Form? You can. So PHA, that's one of the methods that you can use. But when you do that, just make sure that you are tracking that Housing Authority, because they don't send it out to you. They don't send the new schedule out to you regularly. You'll have to either reach out to them or just kind of make, around a certain time of year, just look at their website and make sure, or even call them, because a lot of times their websites are not updated, depending on what city, what county you're in. And when you use the Housing Authority, make sure you're using the most applicable one to your property. City, county, what is it, the COG?
City, county, council of government, or regional housing authority. And you also need to make sure it's a housing authority that issues that has a housing choice voucher program. I got an email last week from somebody that wanted to use a small town here in Central Texas who does have a housing authority, but it is a low rent only housing authority. And their schedule is not applicable to anything that we would manage unless they layered into a program with, a project-based voucher type thing. But yeah, you can use it. But what we're running into, like Yvette said, is they're having a schedule posted on the website that's sometimes even like pre-COVID, like 2018, I think was the one I saw for San Marcos. And then if you email the City of San Marcos Housing Authority, they're giving you one that's got 2023 on it. And so you definitely do not want to just rely on the website. You want to make sure that unless it's a current date, and then you're like, okay, that's probably good. But if it's old, it's probably not going to be the one that's still in place right now.
Right, and you can guarantee that when you get audited, TDHCA, they are going to do their due diligence and call the housing authority and get the most current one. So you don't want them to have information that you don't have, and that's not going to be a pretty picture. So as I said, resident files, that's an important, obviously important piece of documentation. And when we're looking at resident files, we're looking at eligibility, and there's 5 important steps that you want to take into consideration. The first one is to thoroughly screen your applications. And then when I say thoroughly, I mean really go through it. When you're interviewing your prospect, your applicant, make sure that you're looking at their application, looking at their the specifics of their household, what type of income, what their household members, all of that. So you can ask them the right questions, or make sure that you're getting the right documentation from them and nothing's left kind of unanswered or unverified. The second thing is you want to look at household composition, and keep in mind that household composition can mean it will mean one thing for your affordable housing program than it does for occupancy restrictions. You can have 5 people living in an apartment that go towards your occupancy restrictions, but maybe one of them is a live-in aid, so only 4 of them count as household members for your compliance file. So that's going to affect your income limits. You're not looking at the 5-person income limits, you're only looking at the 4-person income limits. And when we're talking about household members, specifically, we want to exclude live-in aides, foster children and adults. And I believe that's it. Those are the ones that so if you have those 3 type of household members in the home, we'll exclude them from eligibility, but make sure that they are still counted as obviously towards the occupancy standards. The next one is to document income and assets. And this is a really important piece because this is like the kind of the big ticket item of your file, the meat and potatoes of it, to make sure that this household actually qualifies and they're actually eligible. Once we have all of that documented, then we want to annualize that income out, count it, multiply it out for the full 12 months of their certification period, starting from their move-in date or their certification date, whether it's the move-in or the annual certification. We're calculating out for the full 12 months. And lastly, so your file itself should read like a book. You should have from start to finish, it should tell you everything about this household. And the most important thing is your executive summary, which is the income certification, or the TIC as we call it. The TIC is going to tell you your household members, the student status, income and assets, rent, utility allowance, everything to just kind of take a snapshot of that household's eligibility. This and it's important that this is signed, it's completed and signed by every household member that's 18 and over. You're telling that you're documenting everything that you verified. They're signing it, confirming that yes, that's an accurate reflection of my household status. So as I said, the income and assets are a super important part of that the biggest piece of that file, that eligibility. So when we're talking about the key income components, you want to make sure that you're, number one, when you screen that household, that you're capturing all sources of income. There's some things that may be applied that your applicant may not have told you, and not because they're intentionally trying to leave it out, but they just may not know that it applies. For example, if you have you may be a single parent with children, you want to, and they didn't put child support, you want to ask them about child support. Maybe that'll, then they'll tell you, oh, we do receive child support. Does it matter? It absolutely does. We need to count all sources of income. For household members 18 and over, we need to count earned and unearned income. And for all household members, we need to count in unearned income, which is family gifts from family. Maybe a child, when it, is receiving monthly $100 a month from a grandparent just as a gift. That's unearned income. Social Security, unemployment. Certain things are unearned income that must be included in your total household income. To document that, we want to look at web-based verifications. A lot of big companies, I think Walmart might be one of them. You can log in online. Your employees can log into a portal online, print their pay stubs or their pay history or whatever it is to show you what their income is. You just have to make sure that it's from a legitimate source. Make sure that you're doing your diligence for all of these, that it's coming from a legitimate source and not just something that is doesn't have the company name or doesn't have the employee name. It has to have identifying information to document without a doubt that this is this person's income. The next acceptable documentation is firsthand documentation, and with this we're talking about pay stubs, Social Security award letters, maybe child support printouts, offer letters from employment that they're about to start. This is firsthand documentation, anything that your applicant or resident can bring into you to document their income. The next one is third party, and this would be like an employment verification or something that you send off to a source and receive back. But with this, again, it's really important to make sure that it's legitimate. You want to document how it's received, that it goes directly from your management team to the source and directly from the source back to you, and it does not go through your residents or applicants' hands at all. Keep a paper trail. If you're sending this via email, print out your email, the to and the from email to show that it did not go through the applicant's hands. And you want to look at the source too. So if you have an applicant or a resident that works at, let's say, Walmart, most likely that email employment verification is going to come from an @walmart.com email address. And if you have a crazy one, crazy @gmail.com, like something like that is just, it's not going to be sufficient. And you definitely want to question it. And it's okay to question your applicants and the source and re-verify if you have to, or ask them to bring in some other documentation that seems more legit. Next, we have oral clarification or verification. This one's really important because a lot of times the documents that we're getting into to verify income is not, it may leave there may be some inconsistencies or just leave some questions unanswered. So it's a good practice to always pick up that phone and document, or make a phone call and ask the questions that are unanswered, get clear answers and document it within that oral verification or clarification form. And the last one we have is self-certification. A lot of times we need these residents to certify their situation. For example, if we have, like I said earlier, a single parent with a child, we want them, we want to ask if they receive child support. And if they don't, then have them self-certify that they do not receive child support. Or if they have multiple children and maybe 2 out of the 3 receive Social Security benefits for survivor's benefits or disability or something, the third one doesn't. It might be it is a good idea to have the third one document. We do not, or the parent document that I do not receive this benefit for this child, just these other 2. That way it doesn't look like it's something that you overlooked. It's something that you addressed. And again, your file reads like a book. Everything's answered. All questions are covered. And you also want to make sure that you're looking at known anticipated income. And with this, we're talking about raises, tips, bonuses, things that are not going to be on pay stubs. Good idea to call and clarify, to ask that. Any changes that are going to happen. If I think around September or October, the Social Security Administration publishes COLA, the cost of living increase. So that's something that we want to take into consideration, treat it as a raise. That's a known change in income. So we're going to count that as it applies.
Yeah, just a few things that I've noticed, especially on the back end, if you're ever dealing with, the IRS or state asking questions, the few things that I've noticed is it sounds silly, but making sure that, your copy is legible, that you can read everything, that if you're scanning it, that it's a good quality. And if you're adding notes, if you can date them or initial and date them, it's so helpful just because it's when you're trying to, unwind something or check something after the fact, having that kind of paper trail, like you said, if you will print the whole email chain so you can see the to and from and all the conversation, that's so helpful. But the same thing goes if you have a document and you're calling and confirming it, making a note that you're dating is so helpful down the road. Because a lot of times, it's not next week when this information is fresh that you're trying to check something. It might be a couple years later. There might be, staff turnover changing, the documentation is so important if you would take those extra steps.
And when the state has a good clarification form, and it has all of that. It has who you spoke with, who they are, when when you spoke with them, what you asked them, what the answer was, the time and the date, and all of that information. So utilize the state's forms. They have a lot of good forms. Some are required, some are not. But it's always a good practice to use their forms because they're going to cover everything that we need them to cover. And
that's a great point. I love if TDHCA publishes a form, I use it. I tell my teams to use it. Right.
Yes.
One thing that some of my site teams gets confused with is that they're doing these pay stubs and they're getting all this information. They think, well, this is what they made, but what are we trying to figure out? We're trying to figure out the next 12 months, right?
Right, exactly. So we're always looking at an income for the certification period, which is the next 12 months from the date that they move in or the date that recertification is effective for the next 12 months. So, they may have received a chunky bonus on one pay stub, but if you clarify and document that that was a one-time thing, they're not going to get it again, and it happened right before they moved in, properly documented, of course, you won't use it, you won't count that towards, because that's not income that they're going to be receiving for the next 12 months of their certification period. But again, it's just really important to document and ask those questions that you need to ask so you can find information like that. And when you do telephone clarifications, handwriting is super important. A lot of times, we're just going so fast and you may understand what you're saying, or you may understand the conversation that you have with the resident, but your compliance department or your auditor won't. We can't understand that, and it's not going to be a clear file. So either make sure your handwriting is legible or just type out that document. A lot of TDHCA forms, you can just type them out and print them. The next piece is assets. So with HOTMA, I'm sure by now we're all pretty aware of HOTMA, the Housing Opportunity Through Modernization Act. Some changes came about, and one of them was that assets are defined into 3 categories. We have non-necessary personal property, necessary personal property, and real property. Necessary personal property, we're not including as assets, and those are the things that you need for everyday life. Your vehicle, your car that's taking you to and from work, your household goods such as furniture, appliances, things like that, whatever you need to that's essential for daily life. Those are not considered assets. But other types of non-necessary personal property, such as your checking accounts, your savings accounts, your cash on hand and investment accounts, those are considered assets that we include. Another thing that HOTMA, let me see, the thresholds. With HOTMA, a threshold was identified, and if non-necessary personal property does not exceed the threshold, which changes annually with inflation, they're not included as assets. And this year, the threshold is $51,600. So any non-necessary personal property that is below that threshold is not counted as an asset, but the income from that asset is counted as income. So we still need to properly document and verify them because we're looking at any interest that account may earn, any dividends that you may receive from an investment account. So we want to make sure we're documenting that. And then we have real property, and that's your land, home, or real estate. Any of that is included as an asset in the household total assets. Acceptable documentation of assets are, so if your household is below the threshold, which again, this year is 51,600, the state TDHCA has an asset certification form that they can sign telling us what their assets are and what the income from that asset is. So we'll use that in what they say, what they certify as income from asset and add it to the household income. But some programs do require documentation. So for that, we would get either one bank statement. We can do a third party. Some programs require the assets to be fully documented regardless of the amount on that first year and every third year after. So it's really important to know your program requirements. And that goes back to the beginning with gathering all the appropriate documentation for your property. Know what your requirements are and know how you need to verify what type of verification is applicable to the program that you have on your property.
And this is so much better than pre-HOTMA.
Absolutely, so much
One bank
easier.
statement. There are little hookups that come about with a one person household that has 3 cars. Are all of those really necessary? So trying to determine what do you count, what don't you count can be a little challenging. But the good thing is the asset amount, unless they've kind of rolling in the assets, it's going to affect their eligibility. But a lot of times we try to tell people just put it down there. It's most likely not going to change if you're eligible or not. But it's definitely a lot easier now with HOTMA.
Well, especially now that the threshold went from 5,000 to 51,600.
Yes.
That's a huge jump. So a lot of our applicants, our household, don't have assets that exceeds that amount. So it's really not, it's rare that it's going to affect their eligibility. And even if they do have assets that exceed that, we're really only looking at the income from assets. So, that big asset is not going to bring in much income to them. So it still may not affect their eligibility. When we're talking about income from asset, we're looking at either their actual income that they receive or imputed income. And actual is going to be anything that we know. We know that a checking account has 1% interest. That's their actual income. Or we know that the checking account has 0% interest. Then that means 0 is their actual income from this asset. Any that we do not know, anytime that we don't know what it's when the income from asset is not clearly identified, we're going to use the imputed income, which is the passbook savings rate. And this changes annually. Now with HOTMA, it changes annually. Right now is 0.45%. So one key tip is to make sure that you're looking at that inflationary chart every year, because that asset threshold is going to change. That imputed income is going to, the imputed passbook rate is going to change. So make sure that you're staying on track with that. And TDHCA, again, they also publish a chart that tells you what those rates are.
We got a
annually.
great question. And I love this question and the way it's worded, because this happens to me all the time. The actual question is Hotmail fully implemented for tax credits? And the reason I love this question is because every time I type in HOTMA into my computer, it changes it to Hotmail. It's like, really? I've Googled this a gazillion times. It's HOTMA. I'm assuming the question is HOTMA fully implemented for tax credits. And in Texas, yes, it's been implemented for 2 years,
January 1st,
January of
2024.
24. So yes, in Texas, if you're not doing it, don't raise your hand. But definitely reach out for some assistance, because TDHCA is awesome. They have just a little quick plug. I made my entire team sign up for their lunch and learns, which they've been doing the entire month of July.
Started in middle of June.
And Kara does the majority of them. I think Amy did last week, but very informative, very helpful. It's a very casual environment for your on-site staff and even compliance folks to ask genuine questions with situations that they have to get real life answers from the state agency. So HOTMA is implemented as of January 1st of 2024 for Texas.
And if you're not using it, you definitely want to, because it made things a lot easier. When documenting eligibility, it made things so much easier. So Yeah, if you're not, definitely reach out for guidance and start using it as soon as possible. So we talked a lot about the lease up. Both Kara and Mike talked about lease up and processes, the big things that go into it. But when we're looking at eligibility, it's important that you clearly identify that the files and they're all important. First of all, you want to make sure that all of your resident files throughout the cycle of the tax credit or the affordability period of the property, the files are important, all the way around. But when you have a lease up, that's when they're extra important, because you're looking at these, the credits are based on this first year file, this residence eligibility. This is the document that says, okay, this unit is now a low income unit. So you can kind of think of it as your first year file as your permanent tax record on which you claim that credit for that unit. So it's really important to be accurate, complete, and make sure that everything is clearly documented, and have a second, third set of eyes looking at these files, so you can, make sure that there's no mistakes and it's documented as perfectly as it can be.
Yeah, we refer to that first year, that first unit that qualifies you as the light switch. So that's the light switch that turns on your credits. And that one is really the most important, because if that one is later found to have issues, then, and you didn't earn those credits, that just has a bigger dollar impact for that first year.
Right. Errors can impact credit eligibility and funding. So make sure that, like Ellen said, that light switch, if you go into a room and the light switch just isn't working, you're not going to be able to see anything. So you're really messing up a lot. So pay particular attention to those first year files. And then ongoing occupancy, equally as important. Like I said, you have to make sure that you are recertifying your residents annually, either doing a full recertification or collecting that annual eligibility form. Make sure that their annual eligibility is documented. Track your next available unit rule. When you have, when your property is ongoing, your residents' income can increase. Sometimes they go over the limit, and that's not necessarily a problem. So just make sure that you are tracking your vacants, when they move out, and whether you need to switch designations, keeping in mind your minimum set aside and your building applicable fraction. All of that is really important through the ongoing process, compliance throughout the life of the property. And then I have some tips for success. Being in compliance for so long, these are some of the things that just automatically pop up. One is to make sure you're diligently reviewing that documentation. Again, that documentation, your residents can tell you one thing, but they may not know that they need to tell you something else. So that's where you come in, do your diligence to ask them those questions, and make sure that you're documenting everything properly. Properly calculating household income, using the proper calculations methods, annualize everything out for the full 12 months, again, starting with their move-in date or recertification effective date, and for the following 12-month period. A big one is to keep in mind that fraud does exist. We've seen it so many times, and it may, sometimes the on-site staff overlooks it because they just, it's so outrageous you wouldn't think to look at it. For example, a pay stub, we've seen pay stubs that have one pay stub year to date is 10,000, and then the next pay stub year to date is 8,000, and it's just, it's not consistent. It doesn't make any sense, or it'll jump from 5,000 to 25,000, and you want to make sure that you're looking at all of those stubs and just kind of not letting any fraud run by you. Of course, we can investigate and catch everything, but just do your diligence to keep your eyes open for weird inconsistencies like that. Conduct internal audits regularly. This one is extremely important because you want to go through your property, look at everything, not just your files, but all the big picture compliance items, and make sure your property's in compliance. And if it's not, fix it. Because once TDHCA sends you that notification that they're going to come out and audit, they're going to find that non-compliance, and then you're going to get that ugly 8823 that goes to the state and to the IRS and to show that you're not in compliance. So you want to avoid that. And the way to do that is to audit your property regularly, do internal audits, as quarterly, sometimes monthly if it's a big property or if a lot's going on, but at least annually, regularly, make sure you do those internal audits. keep your, make sure you're using your current income limits and utility allowances. Like I said, those are updated annually. So use the most recent limits. They usually come out around April timeframe, sometimes June. So make sure that you're using the appropriate limits of your utility allowances. Make sure that they're updated annually. Check the Public Housing Authority, the PHA website, if you use that method, and always make sure that you're using the most current documents. A really important one is to standardize those files. When you have standard forms that you use, a standard organizational process to those files, it's easier not just for your on-site team to kind of know what they're doing and have those files looking consistent and they won't miss anything, but also when auditors come out, they are, they'll get through that file really easily. And the goal is to get those auditors in and out, to not give them any issues or nothing to question or nothing to just kind of look deeper into. And if they see consistent files, then it should be a smooth process, smoother than, as smooth as it can be. The next one is stay up to date with training. Things change so often. Well, lately they've been changing so often, so they can go from kind of staying the same for a lot of years to just changing. And keep your staff trained all the way from your regional, your corporate staff down to your on-site staff. Make sure that everybody's trained. Use CARA, go to CARA's trainings, to TDHC's trainings. They are extremely helpful. My team and I, we all attend those as well. Some good questions are answered. I'm learning things all the time. Things change, different scenarios come up, and staying on top of what's new is the best way to make sure that you're capturing all those changes. Another important one is to integrate your software. Nowadays, we have ResMan and Yardi and all those systems that do a lot of the compliance for us, but they're not necessarily going to be our friend if we don't set them up properly. We don't have, if it's important to have somebody from your compliance team sit with you as you're setting this up to make sure that all your restrictions are captured and are integrated into your software, and that your software is doing the right thing for you. Because if not, your on-site team may not realize, they may just be going with what the software tells them to do and not realize that it wasn't set up properly, or that they're tracking something that they shouldn't be tracking, or not tracking something that they should. So proper implementation of that is important. And then the next one is to make sure that you have a compliance file review, whether it's a third party or your internal team. Get that audit going, that regular audit going, and have somebody oversee your processes and make sure that you're moving in the right direction at all times. And as we've all said, so if you take away anything from this session, make sure you take away that communication is key. Communication is really important. We've all said it. So you want to bridge the gap between development, compliance, and management. A lot of times management may think some things may happen on site that they may think are not relevant, so they may not communicate, but it usually is. So overly communicate, talk about anything and everything, even when you think it doesn't matter, it might. And a lot of times compliance can fix things that management, if there's little errors made on site, compliance can fix it. Or if compliance, has a question, development can answer that, or, all the way around, we need to just overly communicate our requirements. And not just internally, but also with the residents, enhance your resident experience, make sure that you communicate with them as well, because they want, they need to know what's going on, because we ask them for questions, we ask them for documents, we're constantly asking them for things. And if we don't explain to them why, they're going to be more resistant and more hesitant. They're not going to want to, bring us in this personal document of theirs. But if we explain to them the process and why we need it, they're going to be more likely to comply and come in, just keep it friendly, keep them, keep it transparent, and let them know what's going on. That's
All right.
eligibility.
Good job. Good job. All right. Sustainability. I'm going to talk about that middle ground after you've got your permanent financing completed on the after you lease the property up in that 2-year period, now you're sustainable and you want to keep that property sustainable all the way till we get to that end of that 15 years. So again, going to go through this pretty quick because Ellen's got some great stuff we make sure we don't want to miss here. So again, the credit period is 10 years, and it may be 12 years if you have prorates on the front end. But again, it's a 10-year period where the credits are paid out, they're accelerated. The compliance period is 15, that initial compliance period, you've heard that. And then your extended use can go anywhere from 30 or beyond. I mean, you can see 50. So the extended use, you have a little bit less compliance, but you still got to be in compliance with the eligibility that just I'll mention. What I want to talk about here real quickly is the basically how you're going to perform. Basically, you're an affordable community. That means you're not charging market rate rents, right? You may have a mixed use community to help offset that, but you have to be sustainable. You have to be able to still pay all of your bills, and you have to manage through all of that. So again, when you're looking at a pro forma, that might be part of your limited partnership agreement, or it could be a set aside, but it basically has a 15-year projection of what the underwriters thought the income would be in 10 years and 15 years and what the expenses would be. And they normally do a 2 or 3%, 2% on income, 3% on expenses. Nowadays, the underwriters are realizing that didn't work. So now they're doing some things that are a little bit different, looking at insurance and taxes on a different scale, because those are the big things that are happening, utilities as well. But again, trying to predict the future, I don't know about you, but I can't tell you what's going to happen next Friday. These guys are doing it for the next 15 years, right? So again, the performers are normally good for the first 4 or 5 years. And if you're an owner or developer and you're directing your property management team and say, hey, just follow the pro forma, the property deal works if you follow the pro forma, which it does, right? But reality comes into play. So again, make sure you're looking at that and being realistic. Have a schedule for your rent increases. That is how you get money to pay your bills, right? And be sustainable. So again, you have max rents, and I know if the market doesn't bear it, it's okay. But again, in a lot of markets, you can get those rents, and so make sure that you are charging those so you can maximize your income. Budgeting wise, again, talking about habitability, you have to maintain the property. We're not going to talk about Inspire here, the physical inspection that took care of or replaced REACT. But again, the state's going to come out and they're going to inspect the physical condition of your community. So you have to keep the physical condition up from the exteriors also to the interiors. So again, you have to spend some money to do that. So again, look at your needs and do a sources and use needs for your properties each year, and try to make a budget that's realistic. You got to get that approved from a lot of folks, your internal source, but you also have to send that to your syndicator or your investor, and they have to approve it, right? So, but be realistic. You also have replacement reserves. That's an area of funds that you had to set aside, and now you can go tap into it from year 2 to all the way to 15. But there's a schedule behind that, and you should try to follow it. If you try to use it for every little, carpet replacement or flooring that you do, or every appliance, and you go every quarter, you can go get that money and you put it in, and the owner says, thank you, because now my cash flow is bigger and I can put more into the waterfall. But what happens is you get to the days where you have to replace the roofs, and you have to do sidewalks, and you have to do exterior painting, you have to do concrete and asphalt, and all of a sudden you don't have money for that. So again, just be cautious how you use it. Don't try to overuse that in the early stages. There's an operating reserve too that you may have to put into your deal. That is for operational issues. And again, everybody hopes you never ever tap into that, because if you're tapping into your operating reserves, something's gone wrong. You're basically not meeting your debt service, and your NOI is below the threshold, and your negative cash flow. So, but it's there. If you have to, you get approvals from your limited partners and whoever else you need, and you put that into play. Again, AHID comes into play here too. They do have a stabilization period risk rating. We'll go through that real quickly. The next slide here is just a sample pro forma. Again, it just shows income and expenses. This is an example of a 2% per year income and a 3% expense. And like I said, you get to that year, what is that, 15, 16, 17, 18, 19, you're starting to, it's not matching up very well. But again, this is a guide. This is something to look at. Again, if your team has this, you say, what did we think we were going to do in this year? And you can look at it, but then be realistic from there. I wanted to touch on capital needs assessment. A lot of limited partnership agreements today, you will find that they are requiring a capital needs assessment by a third party happen every 5 years. And so your limited partner might say, hey, I want you to have this done every 5 years, and we're going to adjust your replacement reserves. They may ask you to put more money into the replacement reserves because you've been draining it, or the property just has additional needs, and we want to make sure we cover that. So again, from an owner perspective, you don't want to see that replacement reserve go up because it's going to reduce your cash flow, reduce money that's going to go into that waterfall. So again, you need to manage to it. I found a really great secret here on capital needs. We had one, and this is example one. It looks at all your major functions, all your appliances, your HVAC systems, all your major things that we talked about: painting, exterior, siding, concrete, asphalt, all that good stuff. But we had a plan to create or to do a complete exterior paint job the next year when we had our CNA completed, and they had it out 3 or 4 years. And the owner was like, hey, I still want to do this year. I said, well, they're not going to let us, they're not going to approve it. When we get it through, it says, hey, this isn't approved for 4 years. I found out you can call these guys back up and say, hey, can I talk to you about moving some of these numbers around, because we have a different schedule. And I think the numbers still work. That's a key. Don't raise your expenses. Try to stay within that same dollar limit. And those CNA folks will say, yeah, that makes sense. I can move this around. I'll move that paint job up the next year. And so when you look at this, your numbers still work. Our reserve didn't have to be increased, but we still met the owner's goals and objectives of getting that property painted next year. So again, when you get it, don't still go, dang, it doesn't meet what we want. You can negotiate, you can talk to them through that. Again, wonderful AHIC here. Again, they're going to talk to you about stabilization. They're going to look at some additional categories. Debt service, if you hit your debt service coverage ratio, pretty much everybody's happy. So again, that's one of the things. If you can do that, you're in good shape. They also have expense coverage ratios for soft funds. Economic occupancy, again, economic occupancy compared to physical. If you're 95% occupied, but you're only collecting 90, that's your economic. So again, you want to make sure that your delinquencies are being managed. They're looking at your reserves accounts we just talked about, the physical property. They also look again at all those financials of all of the owners and the GPs. Are you sustainable? And then they also will, of course, talk about program compliance. And again, are you in compliance? Insurances, taxes, of course, they are very concerned with making sure that you are paying your insurances, taxes. Reporting is another biggie. When you get into the stabilization period, how are you doing reporting? Are you on time? Very, very important to your syndicators. And of course, recapture and foreclosure is something we never want to hear. So with that, I think, I do have one more slide, and this is about year 15. Yes, we just talked about sustainability and this as compliance 101, but we're talking about when you get up to around year 10, 11, you want to dust out your limited partnership agreement and look about what you agreed to. That is your exit strategy. How do I get out of being a tax credit property, or how do I get my partners out if I want to continue to be a tax credit partner? Again, going to go pretty fast here, but there are some things that you may put in the agreement. Now's the time when you're doing a deal with your limited partner to talk about year 15. If you do that now, then you can know what you're swinging at and you get what you want. If you just say, hey, 15 years, I'm not going to worry about it, then you get what they want, and you don't want that. But there might be something that you must do. Whatever was in that LPA, that is your guide. That is what you're going to follow. That's your roadmap to how to exit the property. That's what you agreed on 15 years ago. Some of those things can be sell the property, close the partnership, distribute the proceeds to all partners via the waterfall, and you're still going to have to abide by the LORA, but you get your partners out and you control that property completely. The GP buys out the limited partner and possibly other partners, again, to get control. You might want to re-up the property and do an acquisition rehab, like Alan mentioned earlier. You did a construction, now you're going to redo the partnership and do an acquisition. Or you can continue the property as is until some future date, because right now the economy doesn't work. Or always you can negotiate with your limited partners and say, hey, what we put in 15 years ago doesn't work. Can we renegotiate something today that'll work for both of us? And there's always that common ground. They want out too. The limited partners, they want out. So again, negotiation is always the key. And that is it for me.
All right, perfect. Thanks, Mike. I'm gonna move a little bit quickly through my slides. We just have a few minutes left. So, but just to talk a little bit, Mike mentioned this earlier. I think the important thing before I'm gonna jump ahead to 8823s and compliance issues in a minute. But the important thing, Mike mentioned it earlier, the LIHTC is a 15-year credit. Qualifying properties can take credits over 10 years. So really, I think that the important thing to know is that credits are earned over 15 years. If you lease up on time, that's what a qualifying property is. If you lease up by the end of that first year of the credit period, you can take it over 10 years. Investors, are always going to project to take it over 10 years, but it's earned over 15 years. So when you hear the word recapture, recapture is talking about credits that you earned later that you took earlier. So I think one of the things, it gets complicated, but if you have compliance issues, you're usually talking about two different numbers. And those numbers, when we talked about adjusters earlier, are real dollars. You can have lost credits that you thought you were going to earn for a year that you didn't because you had a compliance issue. Or you can also, you can also have recapture, which is like the accelerated portion of the credits that you took earlier that you didn't earn until you get to years 11 through 15. So it's complicated, but that's really the 15-year credit is an important concept. And just a note, I think these slides are available online. I'm going to move through some, but they definitely are available on THC's website. I had some slides. I'm sorry, I'm a tax accountant, so I put like definitions in here. I wasn't actually going to read them, but I do think it's important to like go back to the code and see how credits are actually defined. Mike talked about that earlier. So I'm going to skip. I had some examples of like what lease ups looked like in terms of dollars. If you leased up quicker, or if you didn't lease up until, the second year, then it trails into the 15-year period. So if you want to look at some of the schedules, or if you don't lease up at all and don't earn credits, that's the worst case scenario. Never actually seen in person, but it's always the worst case scenario. Talk a little bit about the 8823. So the 8823 is a form, it's an information return that if there's a compliance issue that the state finds during a review of the property, the state is going to send that 8823 to the IRS. Anytime that an 8823 is sent to the IRS, that does increase your IRS audit risk. I have seen, and I think somebody mentioned earlier, the 8823, I'm going to go to the next page. The 8823, on the bottom, the top information is all the information about the building. The middle information is going to be about how many units were out of compliance. And then the check boxes at the bottom are going to show, they're going to show what was out of compliance. It could be a physical inspection issue. It could be an issue with the set aside. It could be an issue with the tenant certification in particular. That first column checkbox is that you're out of compliance. The second column checkbox is that you're back in compliance. I think the IRS is never going to tell us what exactly gets pulled for IRS audit more, but I have seen, I've seen buildings out of compliance. Theoretically, if it's not fixed yet, the IRS is going to look at that stronger. So you want to get those sent, and I think you want to get those corrected as soon as possible. But I have also seen the IRS pull ones that have been corrected. So you had compliance that was out of compliance, it was back in compliance. They can still look at that. That still does increase your credit risk, particularly if you're out of service over a couple year ends. I had one that was corrected, but it was I think it was out of service, 1 year, and then 3 years later it was fixed. So you have a couple years that with potential credit loss, and the IRS will look at those too. Sorry, I think we are about out of time, but I will wrap up here pretty quickly. I think this example here just shows I had one, this is in year 3, we had let's say we had 1 unit out of compliance if it was a certification issue. This shows that my annual credits is $250,000. Because that one unit is out of compliance, that's a real dollar impact of credits for that year. So in this case, it was about I'm gonna not show my math skills, probably about $17,000 in lost credits just from that one unit for this year. And if that wasn't corrected throughout the year, that's gonna impact, the years basically 3 through 11. And that all translates into an adjuster that the investor, basically the general partner at this stage, you probably aren't working with the developer fee anymore. You're probably cutting a check from the owner to the investor. So there's more slides on here on 8823s, but I think we're out of time. So we thank you.
Yeah,
Oh,
we'll,
it's-
we'll
it
make
happened.
sure that we have the slides available. I haven't seen them on the app yet.
Oh,
but
you
I'll
haven't?
get
Okay.
with Tap and see to make sure that they are available. If for some reason they don't, feel free to email me. I'll be more than happy to forward them to you. But we appreciate everyone. I hope I got to everybody's question that wasn't asked live. And thanks for coming.
Thank you.